Okay, hello everyone. This is DBS Group Holdings first quarter 2024 financial results. Right, the date of the information here is as of 2nd May 2024. Right, I initially wanted to do the first quarter, third quarter together, but I realized the video will be too long. So therefore, I'm breaking it up into three. Right, date of recording of this video is 22nd December 2024. Right, so first quarter 2024, the results are very good. You can see again record numbers of the high base of 2023, which was already record numbers. Right, so total income is at a record high, profit before allowance and net profit as well, all at record highs. Right, commercial book total income has rose 14%. Right, the three components have done well. Net interest income, fee income, and treasury customer sales and other income have grown by these amounts over here. Alright, market trading is the only decline, which is 9% from because of higher funding costs, right? But this anyway a smaller component of the income that DBS gets. Right, expenses is up 10%, but actually cost to income ratio is 37%, which is quite low when we see the charts later. Right, SP and GP are quite small, right, which are actually the specific provisions and general provisions. Right, this money they set aside for in the case that the person they lend money to cannot pay back their loans. Right, so tax is tax, not much to say about that. Quarter on quarter I won't discuss because of I'll explain why later. Right, so anyway, first quarter commercial book net interest income is stable. Right, NIM is up 2 basis points to 2.77%. Right, this is off the last quarter of 2.57%. Right, so it has gone up to 2.77%, but that's for commercial book. If we look at group wise, it's actually 2.13 to 2.14, but later on you'll see that actually it's more or less flattish lah. That's the more probably correct way to look at it. Right, loans are up 1% Q on Q in constant currency terms. Right, so that's a good thing because higher interest rates means probably less people want to get loans, but at least the loans are still increasing. Deposits up 1% quarter on quarter. Okay, first quarter fee income growth due to wealth management cards and loan related fees. So basically their fee income aspects, I think everything has grown, right, except cards. Yeah, if I look at quarter and quarter, right, so if I look at fourth quarter is 370 to 536 million, right, that's for wealth management. Right, so this is a very big jump. Right, so you can see wealth management is becoming a bigger and bigger part of the total pie here. Right, so but overall is a growth lah, right, but wealth management is the thing that carries most of the growth in this quarter. Right, non-interest income is up 30%, right, so that's good. Cost to income ratio is 37%, right, so like I said earlier, it's actually a good thing. Right, and some of the cost to expense ratio is due to Citigroup. Right, so anyway, this is still a drop from 44%. Right, so that means they're managing their costs well. Right, so group observations. Right, some of the more insightful things are naturally said by the CEO, right, Gupta. So what are the three things that have outperformed? Total income, net profit, and ROE. Right, ROE is even at a higher record than the previous number, which was I think 18%. Right, so 18% was already a record number, but now they are at 19.4%. Right, beats estimates of 15 to 17%, but later on you'll see that they actually still think this is the number for 2024. Right, loans up 1%, driven by a broad-based 3% rise in non-trade corporate loans. Right, so this again a positive thing considering we are concerned that loans will drop if interest rates go up. Right, so anyway, despite the very good results in first quarter, the CEO has said that it's unrealistic to multiply first quarter results income by 4 because it's seasonal. Right, so their income quarterly is seasonal. First quarter income tends to be stronger and fourth quarter tends to be weaker. Right, I think this one we've discussed. Right, yeah, not going to say too much about this. Right, so wealth management fee is rose from stronger market sentiment and expanded AUM base, and card fees from higher spending. Right, both increases are additionally boosted by base effect, right, including Citi Taiwan consolidation. Right, so net fee income is also another outstanding part lah. Right, it crossed 1 billion for the first time. Right, treasury customer sales reached record high. This one we talked about it. Asset quality is resilient. Don't think we worry too much about that. Right, so anyway, let's look at what Gupta says. right? I'll try to finish this fast. There are still headwinds in Hong Kong because loans continue to shift to mainland, right? So remember that DBS is mainly in Singapore and Hong Kong, and in Hong Kong, because their interest rates follow the US, so they still have high interest rates, whereas in China, they have lower interest rates. So that's the headwind that they are facing in Hong Kong, right? People prefer to go to mainland to do loans because the interest rate is lower, right? So Singapore is affected by mortgage book is affected by soft market sentiment, right? So they are doing some carry trade that is accretive to net interest income, although detrimental to NIM, right? So market NIM came off a bit, so there's some reclassification, and if you put all these things together, group NIM was actually flat for the quarter, right? So we continue to think our original NIM guidance of a slight decline from last year's exit NIM is intact. So I think what they're trying to say is likely the NIM is lower than last year, which is sort of expected, right? So fees were pleasing. Wealth management is up 47% and 37% excluding Citi, right? So even if you include even if you exclude the fact that this is inorganic growth, right? Organically they grew 35%, right? The year ago base was low because of Credit Suisse and SVB, right? But even when compared to first quarter of 2022, we grew 20% in wealth management fees, right? Customers are increasingly putting money to work, with investment products reaching 55% of AUM compared to 50% year ago. There's 33% growth in card fees, alright, but it was flattered by Citibank. But even if you take out Citibank's contribution, the growth was still 12%, which is still robust, right? So so there's a question from the analysts that say in a higher rates for longer environment is good for company margins and stock, but at some point you'll be concerned for asset quality. That means, will the people that borrow money be able to pay back, right? So what Gupta says is that I don't know the answer, right? I said before, I expected NPA, which is non-performing assets, to be higher already 12 to 18 months ago, right? Which is why they're building up general allowance reserves, right? It's one of the big unknowns to me why we're not seeing a greater increase in NPA anywhere in the world. There's a lot of speculation. Initially, it's because of people thought it's because of fiscal support provided by governments, but that would have run its course by now. So there's an element of excess money sort of sloshing around, which has had a big bearing on the availability of liquidity on board, right? So he's saying that somehow I expected the assets to people to not be able to pay back their loans, but somehow there's a lot of money sloshing around, right? So however, you say that if interest rates continue for another 1 or 2 years to be so high, does the other shoe begin to drop? Like I said, I've been expecting it for a year. I won't be surprised if there's more stress, right? Which is why we are hanging on to our excess GP reserves, right? In terms of Taiwan, I think they didn't say so much about this, except that nothing much to say about here, except that they said there are some capabilities they didn't have, like online equity trading. Then they managed to do this for the customers in Taiwan. And of course they offer their products to the Taiwanese as well, right? So this is something if I'm not mistaken, this is what Gupta said, right? So for first quarter, even with enlarged bonus share base, our payout was still in the low 50% range, right? So let's take this as 55%, right? So payout ratio means that how much profits they make, how much percentage of the profits they make they gave out as dividends, right? So low 55% range low 50% range means that, for example, if it's 55%, right, out of $100 they make, they pay out $55 as dividends, which means they kept $45, right? So what this shows is that there's a possibility that the dividends may increase, right? So in order to return all surplus capital, and you'll see that later in second quarter and third quarter, they keep talking about the fact that they got a lot of money and they need to get rid of the money, right? So in order to return all the surplus capital, the payout needs to be much higher. So they expect to increase this. If as just a note, I think I read I cannot remember second quarter or third quarter. Later on, I'll clarify in the next few videos. The most current one I think is 50%, right? The payout ratio. Right, so they at the same time they want it to be sustainable, right? So they want to pay sustainably growing dividends over time, right? So there's music to most people's ears that own the bank, right? So this view on ROE. So Gupta say that long-term guidance is still 15 to 17%. This of the 2023 numbers, right? And this assumes a normalized interest rate environment, right? So again, they just say first quarter more robust than the fourth. I don't think there's too much more to say in this video, right? So this will be the second quarter financial results, which will follow up in the next video, right? Remember, none of this is financial advice, and thank you for listening.